In this video, we're going to continue talking about bond valuation. We're going to concentrate on two topics for this last video, which is we're going to talk a little bit about interest rate risk and how it impacts returns. And we also want to talk about some bankruptcy topics. So let's first talk about something called interest rate risk or price risk. I prefer the term price risk, but that's just me, because interest rate risk, as I learned it, is actually two parts: price risk and reinvestment risk together. They have them separated in this particular text, so we'll go with the flow there. So this price risk is self-defining. It talks about when interest rates change, what happens to prices. So here we have an example where we have a 1 year and a 10-year 10% coupon bond. If the required return was 10%, then the 1 year price would be $1,000. What would happen if the interest rates in the economy, what would happen if they dropped to 5%? If you recalculate the bond price, you'd see it's 1048, which is a 4.8% downward, obviously, upward change in price. If the interest rates in the economy go from 10 to 15, again, we go from $1,000 down to $957, which is a 4.5% change. Positive. Negative. If you look at the 10-year bond for the exact same changes, we see a greater change in price. So what this tells us is that longer-term bonds are more sensitive to interest rate changes in price than shorter-term bonds. So if you were concerned that bonds or interest rates are going to increase, you would rather have a short-term bond than a long-term bond because of the difference in decline in value. However, if you think interest rates are going to go down, it's better to have a long-term bond than a short-term bond because your gains would be greater. How this is illustrated graphically is to draw a line and calculate the values for each required return. You see the 10-year bond is more steep than the 1-year bond, which shows that it is more sensitive. So we're talking about interest rate sensitivity. So long-term bonds are more sensitive to changes in interest than short-term bonds. So now let's think about reinvestment rate risk. This is the risk that you have as interest rates increase or change in the future that has an influence on the cash flows that you'll earn on those future investments. So here we have their example. They suppose you just won $500,000. You're going to invest this money and live off the interest. You buy a 1-year bond, yield to maturity of 10%. So what happens? A 1-year income, you get $50,000, and at the end of the year, you get back your $500,000 to reinvest. But if interest rates at the end of that year fall to 3%, now the next year you're only going to get $15,000. Had you bought 30-year bonds, that income would have remained almost constant, or would have remained constant because you had you had locked in over time at that higher interest rate. So when interest rates change, two things happen. When interest rates go down, prices go up, but your future investment in reinvestment of the cash flows goes down. So one is positive, one is negative. And of course, we want to be aware of that over time. And there is some separate investment investment content or topics where we can talk about how you might hedge against that or how you might offset the positive and negative impact of this changing. So the next thing to talk about is maturity risk premium. Long-term bonds have a high interest rate risk and they have low reinvestment rate risk. Short-term rates, it's exactly the opposite. So yields on longer-term bonds are usually greater than on shorter-term bonds, so that this maturity risk premium is more affected by interest rate risk than by reinvestment rate risk. So again, that's exactly what we just said, that longer term bonds are going to be more sensitive than short term bonds when you think about interest rates changing. The term structure of interest rates is the relationship between interest and maturities. A graph of this is what's referred to as the yield curve. So here we have a picture of a typical Treasury yield curve. You see here, these are times to maturity, and the high point of this graph represents the yields for a bond that has that particular maturity over time. And as you can see, normally this is an upward sloping curve. So you can divide this down or break it down into some pieces. If this is a Treasury security, right? So the real risk is this small piece down here. Again, they have roughly maybe 3%. Here's the inflation premium. And although it's kind of hard to see as you get further out here in the beginning time, you see that inflation premium increases fairly quickly to a point. And then, of course, the maturity risk premium. It's the combination of all these things that represents the yields that you can receive over the long haul with respect to investing in bonds. So next I want to change our discussion just a wee little bit and talk a little bit about bankruptcy. Typically, there's two kinds of bankruptcy, Chapter 11, Chapter 7. Chapter 11 is what's referred to as reorganization, and Chapter 7 is liquidation. Typically, what a company wants is to do Chapter 11. What creditors might want is Chapter 7. So let's talk about these. If a company can't meet its obligation, it files under what's referred to as Chapter 11. This is going to stop creditors from foreclosing and trying to shut down the business. The company is going to have 120 days to file a plan. The court will appoint a trustee to supervise this. Management usually stays in control, but there is a trustee that's going to oversee the process to make sure no funny business happens, like management sells off a big piece of the business or an important piece of the business. So the company has to demonstrate that while we're in reorganization, we're going to be worth more alive than we're dead. If we can't prove that, if we don't have a plan in place, the judge would ultimately order something called Chapter 7 or liquidation. And if the company is liquidated, this is the order in which people are going to be paid. And as you can see, common stock is at the very bottom. They get paid last. So as we go down through the list, we can see that all of these items, right, these get paid off as long as there's money. And when the money is no longer left, there are payments no longer obviously to be made. So common shareholders in liquidation rarely get much of anything. Excuse me. In liquidation, unsecured creditors generally don't get anything, right? So those are people towards the end. This makes unsecured shareholders more willing to participate in reorganization, even though their claims are going to be scaled back. So the choice for unsecured creditors is you get nothing, usually, or if you go along with the reorganization, you have a chance of at least getting some payback. And sometimes there'll be some voting on whether or not the reorganization is approved by creditors. And again, if we can emerge from bankruptcy, we could have lower debts, reduced interest, and we could have a chance for success. So obviously, the company, for the most part, will usually want to go for reorganization. They don't want to go away. They just want to fix their debt issues. So that's the end of this video. I hope to see you in the future in some other videos.